You know how it is. Every single day, the market is just screaming at you with breaking news, panic, and a whole lot of hype. It's this chaotic mess of information, and it can feel totally impossible to navigate. But what if there's a different way to look at it? What if, buried under all that chaos, there's a really clear signal? Well, today, that's what we're doing. We're decoding the long-term playbook of the ultra-wealthy to find it.
And yeah, this quote, this is the world most of us live in, right? A world of constant reaction. A single news story can send shockwaves through the market, and the feeling is always one of bracing for impact, not long-term planning.
So, what does that chaos actually look like? Well, one day it's concerns over AI and corporate debt sending stocks tumbling. The very next, a massive drawdown in Bitcoin creates a wave of panic. And all these fears, they just feed into each other, creating this whirlwind of volatility that makes it seem like the only possible move is to sell, sell, sell.
Which, of course, brings us to the big question of this whole explainer. If reacting to the daily chaos is a losing game, then what's the winning one? How do the people with the most skin in the game not only protect their wealth, but actually make it grow year after year?
Well, it all starts by tuning into a completely different frequency. Instead of reacting to all that short-term noise, they're listening for a long-term signal, one that's built on a foundation of serious discipline and diversification. So take a look at this. This breakdown from the 2025 Long Angle Study really lays out the blueprint. The average high net worth portfolio is incredibly balanced. Notice that public stocks make up less than half of the pie. A huge chunk, we're talking nearly a third, is intangible things like real estate and private companies. This is not the portfolio of a day trader. This is a blueprint for stability.
But hold on, before you can even think about allocating assets, you gotta have the cash, right? And this is where things get kind of mind-blowing. That same study found that almost a third of high net worth individuals are saving more than 50% of their after-tax income. Just let that sink in. More than half of every dollar they earn gets put away to be invested.
And when you put those two numbers side by side, wow, it shows a fundamental, game-changing difference in mindset. While the average personal savings rate in the US is hovering around just 4%, the wealthy are playing a completely different sport. This aggressive saving is the engine that powers their entire long-term strategy. It's not just about investing smart, it's about having the capital to actually make those big moves in the first place. All right, so they're saving all this cash. Where's the money go? Well, the first major piece of the playbook is a big bet on stability, and that often means investing in tangible, physical assets, stuff you can actually see and touch. And you want a perfect example of this in action? Look no further than the ultra-luxury real estate market in a place like Tokyo. In a world of digital uncertainty and currencies that can lose value, prime real estate in a stable global city basically becomes a fortress for your wealth. Now, the key thing to get here is that this isn't just about buying a cool apartment. It's about securing what's called an inflation hedge. Basically, when governments print more money and your cash is worth less, these kinds of hard assets, things that have a limited supply, they tend to hold their value or even go up. It's a classic defensive move. And the scale we're talking about here, it is just nuts. Look at this sales data from Savills. We're talking about apartments selling for billions of yen. That's tens of millions of US dollars for one place. It isn't just speculation. It's a massive flight to safety and quality. But it's not just real estate they're flocking to. I mean, just look at the price of gold over the last few years. It's almost doubled. This is the exact same instinct at play. When financial assets start to feel shaky, investors run to assets with real historical value. And this is where it all clicks together. This quote from Savills Research is absolutely brilliant. They're pointing out that, yeah, these apartments cost billions of yen, but when you measure their price in gold, which has also shot up, the price increase suddenly looks way more reasonable. You see what they're doing? It's not seen as an expense, but as a strategic swap from one safe haven asset to another that they think is a better deal right now. Okay, so that's the defense. But this whole strategy isn't just about protecting wealth. Once that stable foundation is locked in, the ultra-wealthy go on the hunt for explosive asymmetrical growth, and they find it in a place most of us can't even look, the private markets. So how does that actually play out? Well, the Long Angle Study shows this super clear trend. The more wealth a person has, the bigger the percentage they pour into private companies. Things like venture capital, private equity, and direct investments. They are actively trying to get in on the ground floor before these companies ever hit the stock market. And if you want a jaw-dropping example of a high-conviction private bet,
Just look at the AI giant Nvidia. Get this, according to NASDAQ, a whopping 91% of their entire investment portfolio is tied up in one single private company, a cloud provider called CoreWeave. I mean, that is not diversification, that is an all-in bet on a future winner.
So you gotta ask, why? Why go all in on this company? Well, it's because CoreWeave is sitting right in the eye of the AI hurricane. It provides flexible access to the one thing every AI company desperately needs: GPUs, those powerful chips that Nvidia itself makes. With revenue tripling in a single quarter, Nvidia isn't just investing, it's placing a huge strategic bet with what you might call some serious insider knowledge. Okay, let's step back for a second and put all these pieces together. We've seen the insane discipline, the big bets on stable assets, and that hunt for private market growth. So what does the final playbook actually look like when we summarize it?
When you boil it all down, it really comes down to these 4 pillars. First, strategic diversification. That goes way beyond just stocks and bonds. Second, making smart tactical adjustments without getting distracted by the daily noise. Third, a relentless focus on managing risk to protect that core capital. And finally, number 4, actively reviewing and rebalancing everything. This is not a set it and forget it strategy. It is a continuous, disciplined process.
So there you have it. The playbook seems pretty clear, right? Save like crazy, build a stable base with hard assets, and then hunt for that unicorn growth in the private markets. The principles of discipline and long-term thinking, they're universal. But, and this is the big question I want to leave you with, does this playbook only work if you're already playing in the big leagues?